All right, so these are the Chapter 3 PowerPoints. So the first thing to talk about is the balance sheet. And the balance sheet is basically a listing of everything that the company owns in terms of real assets and everything the company owes in terms of debt, in terms of liabilities. And then it shows what the net worth is of the company. Because if you take the assets that the company owns and subtracts everything they owe, the liabilities, what you're left with is the net worth or shareholders' equity. Assets minus liabilities equals shareholders' equity, right? And that's what we get from the balance sheet. It's taken at one point in time on a specific day when all the financial statements have been basically closed and all their calculations have been done. So that's a major part of the balance sheet. Now, for us, one other major part of the balance sheet is called working capital. And working capital is basically equal to current assets minus current liabilities. Okay, and what's important about that is working capital has a lot to do with how our cash is tied up in the business. Let me give you an example. If you were to buy inventory, and inventory is a current asset, and if the inventory account goes up because you bought inventory, that must mean you either paid cash or you took it out on account, like and paid it with a credit card or some other liability like that. And so that use of cash and how it's tied up in working capital is very important, and it's going to come back toward the end of the lecture today. So current assets minus current liabilities, that's working capital, and that's kind of how much a company has to invest in the business just to keep the business working, if you will. That stuff has a short lifespan, less than a year, and it keeps rolling over in terms of inventory, accounts payable, accounts receivable, inventory, and it keeps kind of turning. And when companies say that they're trying to be more efficient in terms of how they operate the business, that's one of the big areas right there, is how efficient is their working capital. And companies try to make that as small as possible, because in a way it is an investment that they have to put into the business. I'll give you an example. Like if you're a retail company and one of your big investments is inventory, you have to buy products, and if, let's say, you have a store, or even if you have an online store, you're still going to put things in inventory. Let's say you're drop shipping from Amazon. You put stuff in inventory with Amazon, and so the more products you have to put in inventory, the more investment you have to put in that business. How would you get that inventory investment down to almost nothing? Then you'd have to do some type of drop ship business, right, where the inventory gets shipped directly from the manufacturer, and you're not using a middle person to handle shipping like Amazon. So that's working capital, and it's very important in how a business is run. The next thing to talk about is book value. Now, book value is basically equal to shareholders' equity for a company. That's what the balance sheet says is the net worth of the company. It's the book value. And the only problem with that is it's based on historical costs of the assets and historical costs of the liabilities. If something's happened with the liabilities, it's based on when they were first recorded. And if you want to know the true value of a company, it's hard to look at those old historical costs and assume that's still true today. So that's why it's important to look at a balance sheet from a market value standpoint. And so we'll look at market value as a way to re-estimate a balance sheet by looking up things like, number of shares outstanding, price per share, to have an alternative way to calculate the value of the company that's a little more in tune with the market as it is today. And another aspect of the balance sheet is mark to market. This really became more pronounced about 10, 12 years ago during the financial crisis. And a lot of banks had some financial securities on their balance sheet, like mortgages, right? And if I know some of you may not remember back then, but a lot of mortgages basically became they lost a lot of value because at the time no one was going to buy it, so these mortgages became what we call illiquid. If you remember, we talked about liquidity, being able to sell something quickly without having to drop your price. Well, back in 2008, 9, all of a sudden, all these mortgages that banks can buy and sell amongst each other because they're like loans, they became illiquid. No one wanted to own them because they were afraid of them. And so what happened then? They had to drop the price drastically. And then all the banks on their balance sheet, they had to say that all these investments in mortgages that they had, the value dropped. And now all of a sudden on the balance sheet, it looked like they had negative shareholders' equity because of that. And what happens then is the regulators who regulate the banks say, okay, you're not worth anything. You have to have enough capital in your bank to make sure that you can pay all your depositors if they want to withdraw money. So you have to start raising money. And so this became a big thing about mark to market. When do you take an asset on a balance sheet and market to its true market value, and when don't you? And the bottom line here is when security is traded, and mortgages are financial securities, and they do get traded. When you can get a market price, then you're supposed to use the market value. Things like if the business bought old computer systems, or they bought some real estate, or they bought a car for a company car, those things don't get marked to market. Those are put in as historical value and depreciated over time. But something like a financial security, when there's an active market and it's easy to look up market prices, well then you're going to get marked to market. Let's do just a couple questions about balance sheets here, just to get a little warmed up. And then we'll go ahead and take a look at a balance sheet. I'll go on, I'm going to go on Yahoo Finance. I don't know if it's really the best site. It's pretty busy with advertising, so you don't have to use Yahoo Finance. I may look up a different one, see if I can find something better that zooms better. So here's a question. If Porsche borrows 100 million euros to buy 30 million euros of Volkswagen shares, 60 million euros in new equipment, and the rest, or 10 million, as cash, what changes happen on the balance sheet? Okay, so let's take the first question here. When a company borrows money, where do you see that on a balance sheet? What on the balance sheet changes when a company takes out a loan? And
your liabilities increase.
What's that?
Your liabilities increase.
Yeah, your liabilities increase, right? So, and most likely it'll be long-term liabilities, right? If the loan has a duration greater than a year. And so you can see that down at the bottom here. So I show this kind of the solutions at the bottom, and it shows long-term debt going up by 100 million euros. Let's look at the second transaction here. Porsche buys 30 million euros worth of Volkswagen shares of common stock. What would change on the balance sheet if they now own 30 million euros worth of Volkswagen stock?
Your assets increase.
Your assets increase, exactly. And specifically, it'll be in current assets, right? And then within current assets, there's usually an account that says something like marketable securities. And so that's where this would go. Right here. marketable securities, $30 million.
Why is it marketable?
Because it's a share of stock that's traded on a stock exchange, and so it's very liquid. It's easy to buy and sell. Now, what happens if they buy 60 million euros in new equipment? Where would that show up on the balance sheet?
That's assets.
Yeah. So you can see down here under fixed assets, it might be something like property, plant, and equipment. That would go up $60 million on the balance sheet.
I have a question. Why is it fixed and not current?
Well, current is something that has a life of like less than a year, or it can, like the duration. So like current assets are things that, you know, can be bought and sold very quickly. And if it's like an accounts receivable or something like that, it hopefully has a life of less than a year. Fixed assets are things that typically a life greater than a year, and you very often would depreciate them because they might lose value over time. Does that answer your question?
Yes.
And so then now the company's going to put $10 million in cash. And so where does that show up?
Current assets, because cash is the most liquid form of
Right.
asset possible.
Right.
First, I have a quick question.
Go ahead.
So just to kind of get off topic just a little bit. So say if I wanted to order, create my own grocery shop, right? And I wanted to sell dried fruits. Obviously the duration of having dried fruits can't go for a year duration. So would this be put under current assets or like fixed assets, or is this something else?
What does everybody else think?
Well, having that is a part of like an inventory. So inventory is normally a current asset because you're going to be selling your inventory. If that answers your question a little better, it's an inventory that you have for your company. And an inventory is a current asset because it can be changed pretty quickly to cash when you sell it. Because food's going to go bad, obviously.
Okay, all right. So
Yeah.
obviously when it's like clothing and things like that, obviously it would come into the fixed assets category.
No,
It's still inventory.
Okay.
Sorry, I'm an accounting major over here, so I know kind of like what you're talking about and stuff. But yeah, no, inventory in general is just like a current asset. It's going to be most likely be sold within a year.
Okay, thank you.
Is cash liquid?
Cash is considered the most liquid. Yeah. Because pretty much if you have $20, everybody will take that as $20, right? You don't have to convince anyone to take it and say, hey, give me $19 in products if I give you this $20 right now, this minute. So it's not like you have to drop your price to get someone to take $20, if that makes sense.
Yeah, I always thought of it like something to sell, and it turns to cash. So that's liquid, but I'm not sure if it's cash itself is liquid.
Yeah, I guess cash is the definition of liquidity, right? It is the ultimate liquid thing. Everything is kind of compared to cash.
Okay.
What if instead of borrowing $100 million or 100 million euros, what if Volkswagen sells $100 million worth of new shares? Where would that end up on the balance sheet?
They would lose the number of shares and increase their cash.
Yeah, basically you're switching common stock for cash, and common stock's part of shareholders' equity.
Yeah, it would go under shareholders' equity.
Yeah.
It would probably show up as a little additional paid-in capital or something like that, but it would show up as shareholders' equity because that's money the shareholders are putting into the business. They're selling shares and they're getting that investment in the company. It's kind of a form of financing. Now I have this slide up here. It shows some historical information on Disney. but I'm guessing this is kind of hard for you guys to read, right?
Yeah.
Yeah.
If you're looking on a phone, on your smartphone, yeah, it is hard to read. So I'm going to try to go to Yahoo Finance now, and I'm going to look at some current numbers. But you know, it's a very busy web page, so I just want to let you know it's going to be busy. And so let me just go through what we're going to look up. First off, we're going to look up the book value of equity for Disney, okay? And right now, the numbers I have here down in the notes of this PowerPoint slide, they're all based on what's in this slide right here in the PowerPoint. So if you have questions, you can look up these notes here, but just make sure you refer to the slide up here for where I got the data, okay? The first thing we're going to look up is the book value of equity, which is the stockholders' equity. And if you blow up this picture on here, you'll see that it's going to be something about 32 million. And it's going to be right around here, 32 million. And just remember that a lot of financial statements, usually they're written in something like thousands of a number. So when it says 32 million, in actuality, it's 32 billion. But what they do is they cut off 3 zeros at the end just to make the numbers smaller and more readable. Okay? So that's book value of equity. It comes straight from the balance sheet. And we're going to, in a few minutes, I'll go on and look at it up on the current Yahoo Finance. But it's coming from right down here at the bottom of the balance sheet of total shareholders' equity. That's book value. Now, when we go to look up market value of equity, it's going to be a little different. This time, we're going to look up the current price per share of Disney and then multiply it by the number of shares outstanding. And that'll give us the total value of the equity, the value of the common stock of the company, or the value of the equity of the company. Okay, so it's a totally different method. We're not looking at the balance sheet. What we're doing is we're looking up the total value of all the stock that the company has issued. And that is the market value of the equity of the company. Okay, and we're going to pull that information from Yahoo Finance again. We're going to get shares outstanding from the statistics link about the company. And then we're going to get the current price per share from a quote right from Yahoo Finance as well. And when we do that, we're just going to multiply the two, and that'll give us the market value of the equity. All right, so I'm going to go ahead and I'm going to share my Yahoo Finance screen. All right, so this is the page for Disney. So if you were to just Google Disney Yahoo Finance, this is the page that would come up for you. Okay. And now you'll see here they have his financials. And so I'm going to go right there, and that'll give us the balance sheet, the cash flow statement, and the income statement. And up comes this. And now I'm going to go ahead and hit balance sheet. Arrows here. And now I can see the current assets and the non-current assets. And now you can see property, plant, and equipment, goodwill, and the different current assets are cash, receivables, inventory. Okay, I know it's a little confusing because the way they use these the little arrows to kind of collapse things. That's how it is. And then under liabilities down here, we can see liabilities broken down into current liabilities, non-current liabilities, or long-term liabilities, basically. And then here's our stockholders' equity. So the current stockholders' equity, 88 million, that's actually going to be 88 billions dollars, because remember, all the numbers shown on here, you can tack on 3 zeros at the end, And how I know that is because if you go up to sorry, my mouse is getting lazy. All numbers in thousands. That's how you know that you have to add 3 zeros to every number that you see. That's important. If you're on a quiz or something like that, and someone asks you, what's the value of assets? And you say, you know, 85 million or something instead of 85 billion, that's a big difference. So that's stockholders' equity. So that's the book value right there of the company. Now, how do we get the market value? So to get the market value, first off, we need to know the price per share right now. And here's a quote that they gave us. It's $132.18 per share. Okay, so now we need to know the number of shares outstanding, multiply the two, and that'll give us the market value of the shares, or the market value of the company. And if I go to this statistics link right here, that'll give us information on the number of shares outstanding. So I'm just gonna scroll down a little. And here you can see shares outstanding, about 1.8 billion. So that's how many shares are that the company has sold over time. 1.81 billion shares. You multiply that by the $131 share price, and what do you get? You get something about $250 billion market value. And I'm going to see here, maybe here, okay, here it is. So right here, 234 billion. So basically multiply the share price by the number of shares outstanding, and that's how we estimate that.
Professor, so what is like the market value specifically like used for? Is it just used to calculate how much the company is worth in case if it wants to sell it or something like that?
Well, what you would do as an investor, you would say, do I think the company is really worth that much? So that's what the stock is trading at. That's what the market collectively thinks the company's worth. But then sometimes you have investors who like try to be more independent, and they're going to look at the company. They might do their own valuation, and then they might say that the company's stock is undervalued or overvalued, and they determine that by comparing how much they think it's worth compared to the market price. And if they think the market price is way too low, and instead they think the company's worth a lot more, then they're going to buy up that stock with the thinking that over the long term, the rest of the market will catch up to their thinking and the stock price will go up.
Okay, thank you. Makes sense.
So let's take a look at the income statement now. Now the income statement, some of the differences between the income statement and the balance sheet, right? The balance sheet is a point in time, what the company owes and what the company owns. The income statement is over a period of time and it talks about how the company has performed. Okay, so the income statement will have things like sales or revenue, expenses, and then it'll have a bottom line we often call net income. Now, some of the important things to consider on the income statement, and we think about this a lot in finance, is that all the expenses on the income statement are not necessarily cash expenses, meaning all the expenses have been incurred, so the company has they owe those expenses, but they haven't necessarily paid for them yet. Okay, it's kind of like maybe you paid for dinner with a credit card, so you incurred that expense, but you haven't paid cash for it yet. And so that's an important distinction later on, that the income statement is about when those expenses were incurred. So like if you take some inventory, and as long as you don't sell it, even if you buy more inventory, it doesn't show up as an expense. Only when you sell that inventory do you also at that point incur the expense of the inventory that you bought for that sale. okay? Because this difference between when things are incurred and when they're paid for is pretty important in finance. So I just want to make that distinction. And then the cash flow statement. So the cash flow statement, the intent of this is to give the investor an idea of how well the company is liquidity-wise, right? Because the income statement gave you an idea of when expenses were incurred. So it's meant to give you an idea of the economic profits of a business. And by economic, I mean they try to line up when something was sold and the cost of that when it was sold. But that doesn't tell you the cash flow, right? Because if you buy those dried fruits for your store in January, but then you don't sell those dried fruits until June, that's about 6 months when you've been out of cash and you haven't gotten the cash back yet. That's very important because you could run out of money during that time, okay? On the income statement, it's going to look like everything's going fine because the cost of buying those fruits will only be put on the income statement once you sell the fruit. So they'll see your markup and you'll be fine. But on the cash flow statement, they'll see that you gave out all that cash to buy the fruit, and now, you know, in May you still haven't gotten anything back, so your cash flow is pretty negative, right? And in that time you could go out of business because you don't have enough cash. So that's why it's pretty important to study this cash flow. So cash flow is separated into 3 components on the cash flow statement. There's operating cash flow, and that's kind of the day-to-day operations of your business, the producing goods, the selling of goods and services. And then the other 2 parts are the investments, investing cash flows. That's like the, remember we were talking about the capital budgeting and investment decision, where a company figures out what they're going to invest their money in, what real assets they're going to buy that will help them produce goods and services. So there's a special section on the cash flow statement for that, and that's the investment section. And then the last section, the last of 3 on the cash flow statement is called the financing section. And there again, remember we talked about the financing decisions where a company decides where they're going to get their money from. That's where you see that on the cash flow statement in that last financing section. Now, just looking at the cash flow section, the basic equation for figuring out cash flows from operations is just net income plus depreciation minus increase in working capital. You'll see a couple different other additional accounts when we look it up online, but those are the basic 3 accounts that we have to look at, because what we're doing here is we're not actually calculating cash flows by just looking at every single dollar that went out. The way cash flow from operations is calculated, it's like instead of doing from the ground up every single cash expense, what they do instead is they start off with net income, and then they make adjustments to net income to get to cash flow. And so that's how you see this equation. The reason it starts with net income is because it's kind of easy to do that, and everybody has that information. So then we just make some adjustments to net income to get the cash flow from operations. And the first thing you see here is it's adding in depreciation. And the main reason to add in depreciation is because, well, think about this. Net income, when you take net income, you subtract depreciation, right? And so, like, say example, you have a if you have your own Uber business, right? So you're driving Uber car, and you buy a car. And let's say you're not leasing the car. Let's instead say that you bought the car outright, you own the car, and that you take depreciation every period for that car. So that depreciation, even though you didn't pay out money for depreciation every month, you're still going to record that as an expense. and that goes into net income. But the problem with depreciation is not a cash flow, right? It's just an economic estimation of the reduction in value of a fixed asset. It's not the cash flow. So when we calculate cash flow, we have to add that depreciation back in. And that's why you see here it's net income plus depreciation, because we know we shouldn't be taking out depreciation when we're calculating cash flow, but net income takes it out, so that means we have to add it back in. I know it's a little confusing, but that's just kind of the practice of how it's done. And the last thing, the last main category for cash flow from operations is this increase in working capital. And I think the easiest way to think about this is, remember, net income on the income statement, it doesn't really take into account when you buy more inventory. Instead, it only recognizes when you sell that inventory to take into account the cost of goods sold. But when we're doing cash flows, we want to know if you're buying more inventory using up cash. Okay? And again, inventory is a type of working capital. Working capital is current assets minus current liabilities. And I think whenever you see a working capital question, for me, the easiest way to think about it is just think in terms of inventory. Okay? So let's say if we increase inventory, what does that do to our cash flows? You know, assuming we paid for it already. If we increase inventory, we had to pay money for that. That means our cash goes down, right? So increasing inventory reduces cash. Now look at the equation, right? Minus increase in working capital. So the reason it subtracts an increase in inventory is because if you increase inventory, it reduces your cash. So that's why the formula is the way it is. Okay? So those, that's just some of the basics behind cash flow from operations. And then when we go to the bottom of the cash flow statement, where they take the three categories of operations, investments, and financing, they basically add all those three together to get the total cash flow for the company. And that kind of tells you, you know, kind of the overall health of the company, if they're taking in enough cash, if their cash is going up or going down for the year. Why don't we, with the risk of having Zoom go out again, I am going to go on and look at the cash flow statement. All right, so here's the cash flow statement for Disney. And notice how it's broken up into three parts here. Cash flow from operations, cash flow from investing activities, and cash flow from financing. And then at the bottom line, they look at the change in cash flow. Okay. Let's look at the operating cash flow. So here you see they start off with net income, and then they make adjustments to net income to get to cash flow from operating activities. So you see depreciation, amortization. Some of this stuff we're not going to worry about too much. Deferred income taxes can be a real pain in the neck to calculate. Stock-based compensation, we're not going to worry about that right now. But here, a big one is change in working capital, right? And then they list three types of working capital: inventory, other working capital, and some non-cash items. So that's the working capital. And then under investing activities, they have property, plant, and equipment, other investing activities, and some acquisitions. So like when Disney bought, you know, the company that owns Star Wars, that would have gone under that acquisitions part right there. And then finally, financing activities. You see debt repayment, buying back stock, paying dividends, other types of financing activities. Okay, now we have a, in finance, we do have a little bit of our own calculation for something called free cash flows. And it's a little bit different than what you see in the financial statements. And it's because we take into account not only cash flows, but we also take into account any type of capital expenditure, taxes, depreciation, all that into account, but we do not include financing. Because in finance, we like to calculate the cash flows and the value of a business before we do anything with finances. The finances are seen as a separate decision that we take care of when we're valuing a business, and we want to know how the business operates unto itself in terms of operating cash flows and investing cash flows. But we don't want to think about financing because we do that in a separate process in finance. So we kind of calculate our own cash flows, and you can think of it as cash flow available to the firm, but not the finance holders. Okay, so so here's how we calculate it. It's kind of a unique calculation, and I'll go through it and try to explain some of the purposes for these numbers, but we're kind of using the same technique that you saw in free cash flow to operations, where we start with an earnings number and then we make adjustments to it to get to cash flows. So here's the equation right here. Okay. Now, instead of net income, and remember, net income includes things like taxes, and it includes interest expense that you pay on loans. And loans are a type of financing. So in finance, we don't want to include that in our cash flows. So that's why we start with EBIT. And so what is EBIT? EBIT basically stands for earnings before interest and taxes. Now here's one of the fun things about finance. You'll notice in accounting too, sometimes there are 2 or 3 words that mean the same thing, and different people will use the different versions of the same of that word, and it can get a little confusing. And this is one of those things. I've seen some people call it EBIT, earnings before interest and taxes, but when you look at financial statements, a lot of times you'll see it called operating income. And when we go into Yahoo, I think you'll see that it's called operating income. But just remember, EBIT is the same as operating income. And part of that is just learning the language of finance and accounting, that sometimes we do have words for things, and they might mean the same thing. So that we start with EBIT. Now, EBIT, earnings before interest and taxes. And taxes are a cash expense, so we have to take out cash taxes. So that's why right here you see minus taxes. Okay? And then the next step is we have to add back depreciation. Why do we add back depreciation? Because depreciation was taken out of EBIT. But depreciation is a non-cash expense. So really our cash flow is higher before we took out depreciation. So we're going to have to add it back in. And I know this gets a little confusing, right? But when you calculate EBIT, you take out depreciation, so then you can then calculate your taxes. And so we need to take depreciation into account when we're calculating our taxes, but when we want to know cash flows, we kind of have to add it back in. So we have EBIT, we subtract taxes because those are cash. We add back depreciation because that's not cash. And then we subtract working capital. Right, that's the same thing that we did when we did the cash flow from operations on the cash flow statement. And the main reason there, again, is because in the working capital area, you see things that cost cash, that cost us money, but they have not been incurred yet as expenses on the income statement. So we need to take that into account. Now, why do we subtract an increase in working capital? Think about working capital as inventory. That's the easiest way for me to remember this. And if you increase inventory, that's going to cost you cash, so you have to subtract it because your cash flow is going to be lower. So that's why there's a negative sign here. And then we subtract financing cash flows, or I just put down here minus capital expenditures. Now here's a tricky little question. Can we just use cash flow from operations and subtract capital expenditures? Can we use that for this calculation that we just did? And the answer is no. And the issue here is interest expense. And this came up before, why we're using EBIT and we're not using net income, because we do not want to include interest expense in this calculation of cash flows, because in finance, right, we keep all financing cash flows separate. Okay, so that's again why we're using EBIT and not income, because net income, earnings before interest and tax, you take out interest for loans, you take out taxes, and then it takes you to net income. And we don't want interest, so that's why again we start off with EBIT. I'm going to show you where some of these numbers for calculating the free cash flow exist. So the first thing we need in that equation was EBIT, right? And so EBIT's going to be on the income statement. So we go to the income statement, and it looks like we're looking at the annual income statement for TTM. Does anybody know what TTM stands for? Trailing 12 months. So that's the last 12 months. Time to maturity. So I'm going to write it here.
Sorry, I wasn't sure.
Oh, that's okay. Trailing 12 months. And what they mean by that is it means it's probably not the normal fiscal year for the company. Let me give you an example. Let's say the fiscal year for a company, and companies get to choose their own fiscal year that they report on their financial statements. And very often fiscal years start in September. Just because that's when the selling season in the spring is over, they've gone through the summer, and now, September, the new fiscal year usually starts, and that's with a lot of companies. And so if we want to know the last 12 months of income, and we're not starting in September, that means we're just going to use the last 4 quarters of financial statements, and so they'll just use the last 12 months as opposed to the September to September fiscal year. And so that's why trailing 12 months. Okay, so we want to know earnings before interest and taxes. And check this out. Here's net income. Here's the income tax expense. And here's interest expense. So we want earnings before interest and tax, so the number right before that. And that's going to be our operating income right here. I apologize. I know that can be a little confusing using different names for things, but some of it just comes from practice. But in the homework or quiz, I'll try not to be confusing like that. I'm going to keep it pretty clear. But it's good to know that out in the real world, sometimes different terms are thrown around like that, and they mean the same thing. So there's our operating. So this is where we would get EBIT right here. And if you remember that equation, it's EBIT minus taxes. There's taxes right there. okay? And then we want to add back depreciation in that equation. So where do we get depreciation? We have to go to the cash flow statement to get depreciation. And it's going to be under operating. And there it is. So there's depreciation. So we got EBIT, we subtract taxes, we add back depreciation, and now we have to subtract the increase in working capital. So this one's a little more confusing. It's not just this year's working capital, but the increase in working capital that we have to subtract. Right? Because why is it the increase? Because think about it this way. If you just think about it as inventory, if last year we had the same level of inventory as we do this year, then we didn't really have to invest more cash to buy more inventory. But if from last year to this year we doubled our inventory, it's that increase that is correlated to the cash that we had to do to pay for inventory. Okay, so that's why we subtract the increase in working capital. So where do we get working capital? That's going to be on the balance sheet.
I have a quick question.
Yeah.
If the working capital is actually decreased, then would you add it up, or do you just leave it alone?
Yeah, it becomes a double negative, so you actually end up adding it. Yes.
Thanks.
If you see a company that's like liquidating all their inventory and not replacing it, that's basically what it is. They're having an inventory blowout because they're going out of business, that kind of thing. And so you'll see a drop in inventory, a drop in working capital, and what that does is it liberates cash into the business. And you see that in the equation. You subtract the increase, but if it's a decrease, it's like a double negative, right? So you're actually adding back a reduction in working capital to cash. If you reduce working capital, it puts cash into the business. And basically what you're doing is you're selling off inventory and not replacing it, and that'll actually inject cash into the business.
Makes sense. Thanks.
So I'm going to look at assets, right? And we're looking at current assets, right? There we go. So here we are, here we have current assets, and here we have current liabilities. So if we take current assets and we subtract current liabilities, that gives us working capital for this year, right? So in this case, it would be 28 million minus 31 million. And that's going to be something like minus 3.2 million, right? A negative number. Okay, so remember that minus 3 million approximately. And now remember we have to look at the increase in working capital. So now we have to look at the previous year. And the previous year had current assets of 16.8 million and current liabilities of 17.8. So what's the working capital for that year? And I'm going to have to write this down. I think you might have to write it down as well. So that looks to be about negative $1 million, right? Now I know it's in thousands. So for 2018, we have a working capital of negative $1 million. And for 2019, we had a working capital of, what was it again? 28.1 minus 31.3, so that's about 3.2 million, minus 3.2 million. And it gets a little confusing with these negative numbers, but look at it this way. So in 2018, we had negative $1 million working capital. And just so you know, a negative working capital number is very, very good. What it means is the company is so efficient that they don't have to invest cash to normally run their business. Okay, it's kind of like, let's say to get the dried fruit for your store. Let's say you didn't have to put out any cash at all. Let's say that the person who sold you the dried fruit said, oh, don't worry about paying me now. Why don't you pay me once your customers pay you? So now he gives you the dried fruit, right? You wait a couple months to sell it all, and now your customers paid you for the dried fruit, and now after you're paid from your customers, now you go back to your supplier and pay them. So in effect, you didn't even have to have any cash in the business at all. That's an example of negative working capital. And it's not normal for a lot of companies, but maybe Disney's kind of a unique company. So 2018, we had negative $1 million in working capital, and 2019, we had negative 3.2 million. So actually, working capital went down. It's a negative number. It went down from negative $1 million to negative 3.2 million. So that's a minus 2.2 million drop. So a minus 2.2 million drop in working capital. Now let's go back to our equation. So that means this number right here is going to be minus a negative number, 2.2 million. So two minuses make a positive. So that means this number here is we're actually going to be adding $2 million toward our cash flow. Okay. And the last number we need are capital expenditures. And capital expenditures we can get from the cash flow statement. And that would be right here, cash flows from investing activities. So we could go ahead and use minus 4.3 million. Now, in this case, they're showing negative 4.3 million because they invested 4 million, and then they're going to subtract it in this table right here to get cash flow. But for our purposes, capital expenditure, we already have the negative sign right over in our equation. So I'm gonna jump back to that equation, and the main thing here is that when it comes to capital investments, right, we don't need to use that double negative here because capital expenditures are right away money that's being sent out of the firm. It's already a negative cash flow, and we have that negative already built into the equation. Let me show you. Okay, so right here, we would just use the 4.1 million, and we wouldn't use the double negative in this case, okay? And so in the problem, I'll tell you what capital expenditures are, and you would just plug that number in right here and not worry about the negative sign. It's already built into the equation. Just use it as is in the equation. I'm going to skip this question here. The main thing is that the cash flows are a little different than you see calculated in the cash flow from operations financial statements. And again, it's because we're using EBIT. We're not using net income like they do in cash flow from operations on the cash flow statement. So just remember, the way we calculate this is a little different than is normally done in accounting. That's the main point here. Now, all the kind of the calculations we just went through, they're also shown on this slide, but I wanted to kind of show you live. But some of the data is not live anymore for this one. This one I pulled the data from 2008, and that's not shown on Yahoo anymore. But on here in these notes, you can see the steps I went through, and it has the cash flow statement from 2008 on Disney, including how to calculate working capital. Here's the part on working capital. So you can go through and see it all typed out. And then here's the final calculation with free cash flows. So in the end, what we did is we found EBIT on the income statement. Then you add back depreciation from the cash flow statement. Then you subtract taxes. That's on the income statement again. Then you calculate the increase in working capital. We did that on the balance sheet, right? We took this year's working capital and subtracted last year's working capital, and that's the increase, okay? And then we went to the cash flow statement and we got capital expenditures and plugged that into our formula. So that's how we calculate free cash flows to the firm in finance, okay? I'm just gonna, what this slide basically talks about is just to make you aware that the net income for companies is not necessarily a pure, always correct number. And what I mean by that, going into net income, there are a lot of estimates that companies do. It's not a perfect science, okay? So, and sometimes because of this ambiguity on how to estimate expenses and when to incur them, sometimes companies take advantage of this kind of gray area and they can manipulate their earnings somewhat. And sometimes we call this earnings management. Sometimes it's called earnings manipulation. Sometimes it's called smoothing earnings. And companies can do this in different ways. Some of it's legal, but some of it's also illegal. It depends on what they're doing. Let me give you an example. Let's say that this year our corporation is doing very, very well. Right? We're going to have high profits at the end of the year. In fact, let's say we're going to even beat our targets. So we're going to go past our targets. So what companies might want to do then is like, hey, let's figure out how to reduce our earnings this year and save some of those earnings for the following year, because we don't know how the following year is going to be. So what they could do is they could say, you know what, next year we're going to hire somebody or we're going to incur some type of expense. Why don't we take that expense this year and write it up as a prepaid asset? That way they get to record the expense now and it reduces their income now, right? As opposed to waiting till next year to record that expense. And so that's how they can shift expenses from time period to time period by using the accrual process. And it's kind of a gray area whether or not, you know, you know, whether or not it's right. And so that's why you don't see companies getting in trouble for it, because it's a little of a you know, it's a decision process that they have to make based on their estimates. And auditors can't always catch that, and they can't always say it's necessarily wrong. So that does go on quite a bit, but we do have some different ways of catching it. And how we do that is we look at balance sheet ratios and we compare two like companies based on those ratios. Like, how much prepaid assets does this company have compared to total assets? And how much does this other company over here have prepaid assets to total assets? And let's compare all those same companies in the same industry. And wow, this company over here, boy, they had a really great year, but then their prepaid assets went up really high. Oh, they must be smoothing their earnings. They took some extra expenses. So that means maybe next year they're going to do even better. So that's just an example of some of the things that companies could do. So just so you're aware of it, it's not something you know have to know how to do or how to catch, but at least you've been exposed to know that, you know, the net income is not always a pure perfect number, and there are estimates that go into it, and companies do have some flexibility in how they show those the numbers that they get. I'm just going to review kind of a basic calculation for taxes. Okay, and it's fairly important because when we make investments, we always take taxes into account because it's a cash flow. And so here's a simplified way of looking at taxes. And so this is a tax schedule. And a tax schedule basically means that for different levels of income, you pay different tax rates, right? And the way this one's set up, for the first $50,000 of income, you pay 15% tax rate. And then for the next 25,000 above that, you pay 25%. And then it goes on up until at the top tax bracket, anything over about 18.2 million, you pay 35% tax rate on. So so this is similar to your personal income taxes. I mean, they're kind of calculated in the same way in terms of having tax brackets. And here's an example of how it would work. Let's say we've got taxable income of $75,000. Okay, calculate the tax on $75,000 of income. What would that be? Here's the calculation right here. Okay, and you can see here's the first $50,000 of income, and we pay 15% of that. Okay, and now remember it's $75,000 of net income, so that means above 50,000 we have another 25,000 in income, and that portion of your income we're going to pay a higher tax rate of 25%. So then we add those two up and we get 13,750. Okay? So you have to pay taxes on each of these brackets, and as you go up, you have to pay more taxes on each part of your net income. Now, interest expense is tax deductible for companies, not for you and me, unless it's like I think you're able to deduct some of your student loan expenses, and you're also able to deduct some your mortgage interest expense. But for companies, any type of loan they can deduct. It doesn't matter what the loan is for. So let's assume that this company has $24,000 of interest expense. If that's the case, their net income, instead of being $75,000, their net income is going to be $51,000, right? $75,000 minus $24,000, right? So that's their new net income. So what would be the tax they owed on $51,000? Well, the first $50,000 is going to be taxed at 15%, so that's that. And then above that, they only have one more $1,000 of income, and that will be taxed at 25%. So the net result is, with the interest expense, they pay less taxes. So $77.50. Okay. And it looks like we're about out of time. I'll be quick on this slide. Two types of calculations on taxes. One is the average tax rate, and the other one is the marginal tax rate. The one that's important for us in finance is this marginal tax rate, because that tells you your tax rate on all future extra income. Okay? Average tax rate takes into account your taxes paid at every single taxable bracket that we did on the previous slide. So it's total taxes due divided by the total income. Okay? And on the previous slide, right, on the first example, we had $13,750 of taxes paid on $75,000 of income. So our average tax was 18.3%. So it was somewhere between those different tax brackets because it was an average of those tax brackets. But what's the marginal tax rate? The marginal tax rate is if we had one more dollar of income, what would that dollar of income be taxed at, right? And the marginal tax rate for us, if we're at $75,000, I'm going to go back to here. At $75,000, that means we're going to start being taxed right here, right? So the marginal tax rate for $75,001 is 34%. What's the next dollar tax rate? That's the marginal. So that's 34%. And that's the average right here, the answer right here.